The first thing I want to talk about is real savings and liquidity. So, I mean, most Americans, I think, know that we are really bad at saving our money, and we're really good at making it. And I'll kind of dig into that a little bit more, looking at some pretty eye-opening numbers and how it's the problem is not the money we're making. The problem is that we're not keeping most of it. So, and why some of the reasons why relying on the stock market for savings is risky, or just relying on what where most people do is savings accounts in a bank, and how they aren't really very good. Usually the rate of return is quite low, and they're just it's not very conducive to real savings. And then whole life insurance as a secure and predictable savings vehicle. I'll go into how these large banks that you all know about, the Bank of America, Wells Fargo, et cetera, to keep huge amounts of cash inside whole life insurance, which most people don't know about. So why is that? So I'll dig into that a little bit. And then there are added layers of guarantees and stability that these whole life insurance contracts provide. So here's a quick example. So say you have someone named Jessica as a small business owner, needs 300, say $30,000 to expand on her cafe, and she could dip in her savings and to do that, but the timing wouldn't be great. She doesn't really want to tap into the 401k. She instead had set up one of these whole life insurance contracts, and the cash was called the cash value inside of them is always available for her to tap into. No questions asked, no credit checks, nothing like that. So these are very much like a savings account line of credit kind of an asset where you can tap into whatever you need to tap into whenever you need to do it. And the great thing is when you tap into these contracts, you don't actually take it out of there. You take loans from the life insurance company based on what's in your cash value, which means that you can replenish it and you can use the same dollar over and over again.